Hi everyone. Welcome everyone. We'll just wait a couple of minutes to let everyone join in, and then we'll get started. I'm Prerna from Kernel. I'm new. I've been here for roughly 6 weeks. I am the head of distribution, so I look after the distribution side for Kernel, looking after charitable trusts and EBs. So my job is predominantly looking after relationships on that side. Yeah.
Welcome everybody. Hope you're having a good evening and settling in. Like I say, we'll give it a couple of minutes to let everybody arrive and get turned on and live. It looks like it's been a stunning day across the country for everybody. So hopefully we'll have a few people join us. If you can hear us, make sure that everything's all okay. Drop us a chat. We've had a lot of questions come in over the past week or so. So we'll try and get through everything we possibly can. But equally, if you're there live and stuff comes up, you want to talk about it, just drop us a comment. We will dive into each of them as we go. Anything that we don't get a chance to touch on, we will circle back, send you an email after, or organise another session. So thanks for joining us. And thanks, Prerna. Welcome, obviously, 5 weeks in. A good chance to obviously dive straight into the deep end of Kernel. It's been a busy 5 weeks here. Obviously, we've launched a few new funds over that period. We've got a lot happening with the platform that's going to be coming out as well over the next few weeks. So plenty to keep an eye on and plenty for us to dive in this evening.
Yeah.
How have you found 5 weeks?
Intense.
Yeah.
Intense, but really good. Really proud to be working for Kernel, and the things that we're doing here is amazing. It's awesome having people like you, join us and get to learn about our new funds, and just ready to kick into it and hopefully help you guys get a little bit more information.
I think the biggest thing is probably most people don't appreciate how much goes into an index fund.
Yeah.
Behind the scenes.
Yeah.
There's a lot that happens to deliver best quality index funds in the market. So we're happy to dive into some of that today. So I guess kicking us off, one of the things that has happened since you've been here is we've launched a couple of new funds. Some of those have been hedged, and we've had a lot of questions come in as to what does that mean? What is hedging? We've been writing a blog on that behind the scenes. There's been a bit of commentary around the markets, currencies. So we thought this was a chance to sort of dive into that, answer those questions that have come in, dive into a few more technical things. We will try and explain them as simple as possible. Some of these are things that actually are not always that easy to articulate in a couple of sentences, but hopefully you'll get your answers. Again, encourage you just even pop a comment in saying hi, that you can hear us okay, and any questions that come through as we go. So let's kick off.
Don't be shy. So pop your questions through and we'll try and get through as many as we can. So I guess predominantly what I want you to start off talking about is, give us a little commentary of what you think the market's been like for the year 2022 and what we can expect going forward next year.
The crystal ball, the thing that I guess we will never have an answer to, and I guess the purpose of index investing is that we're not trying to time the market, we're not trying to call things, we're not trying to make predictions, and actually successful investing is nothing to do with that. It's actually about the habits and focus on outcomes. But looking at what has happened in 2022, it's been pretty unprecedented for a number of reasons. At a high level, we've actually had interest rates falling for the past 40 years. And now all of a sudden, we've got a very rapid rise of interest rates. We were effectively at 0, and now we're up to sort of 3.5% or more. And so it's been a really strange year for many people, stuff that we've not experienced in decades. Interestingly, we're looking at today, some of you may be familiar with kind of a balanced portfolio. So 60% sort of growth assets, 40% income assets, so shares versus sort of bonds and cash. A 60-40 portfolio in the US has actually had one of the worst performances since the 1930s depression period. And so it's been pretty phenomenal what has happened so far this year. It's a bear market that we've experienced. Many people may not have had that in their investing life so far. We've also seen now rising interest rates, rising inflation, falling house prices. So what are you meant to do? I guess what we've seen is, interestingly, from the customers at Kernel, it's been really heartening. 95% of all of the trades that we've seen so far this year have been buy orders. And I think that's a testament to the mindset of the customers that we've been able to come on the journey with us at Kernel, where they are focused on long-term wealth building. They are focused on regular investing, contributing to their portfolios, the things you can control. Now is just as equally good a time to invest as it was 12 months ago when the market was higher. And so I think it's been encouraging for us to see some of those really good behaviors coming through so far this year. And the reality is that we are kind of seeing a bit of a plateau with things. And I think some people are starting to go, okay, maybe what do I do now? What do I do for 2023? And we'll dive into a bit more of that over this evening.
Yeah, I guess since we're on the market topic, and 2022 has been a really interesting year for markets. So the market drop has created a lot of opportunities for buying individual stocks. So why invest in an index fund, which may be slow and steady, when one could potentially achieve greater and faster gains, by buying sound individual stocks?
Yeah, I think this is a really interesting point. There have been factors so far this year that we've not seen in decades that should make an environment where potentially people go, well, is this now a time where active management or stock picking should outperform? I literally was on a call this morning with this. A really interesting stat that I found today was actually so far this year, 96% of actively managed funds in the UK have underperformed an index. So despite the volatility in the market, despite sort of the chaos where you think picking stocks or picking sectors should mean or create more opportunities to outperform, we're not seeing that yet in the data. And in fact, globally, 51% of US actively managed funds so far this year have underperformed. So it's still been a luck of the draw over a very short period of time. So the key things that you want to focus on, though, in any environment still hold true, which is diversification. And that's what index funds give you. From the very first dollar, you're well diversified. And what we've also seen this year is the big names that people have known, the big tech stocks, have not done well. And that is, again, a good reason why being diversified, why having something like an index fund that owns a large part of the market is actually a really powerful tool that over time that does really well. It will give you the market return. So that index investing, the regular investing piece is, it remains true through all market conditions. And often where there are periods that we've seen in history where potentially it's a chance to try and pick some winners, are very short-lived, often don't prove to add long-term value. And if you are building long-term wealth, you need to focus on the things that will get you to that journey. So diversification, low fees, regular investing, those are the key things that really matter.
Okay, and on that topic, because markets are, I guess, low at the moment, do you think prices of these individual stocks are realistic? Like, how would you describe when people are like, oh, look, I don't think it really matters from a market level. There are a couple of things here, right? Is it now a good time to invest? Hey, people were investing 12 months ago when markets were significantly higher than they are today, and everybody seemed to be wanting to invest. Regular investing is key. We had a question that came in, is it worth putting $100 a week into investing? This is a great question. It 100% is. And actually, that's probably the best attitude. If you haven't seen it, we produced a blog that's on our website, how to perfectly time the markets. And we ran those scenarios. We ran the scenario of somebody who regularly invested $100 a week versus somebody who saved up their money and tried to time the tops and the bottoms. And I encourage you all to go and read that blog, because what you'll find actually is that the investor who simply put $100 a week away had a very stress-free investing experience and actually did just as good as somebody that could perfectly time the market. And it's impossible to perfectly time the markets. So it doesn't really matter what today is. The other big thing I think is a good reminder of why being in the market and being long-term focused is last week we had the CPI announcement, the inflation data come out of the US. And that was, by the way, the highest single day jump on the back of an piece of inflation data in history. So over 5% jump in a single day. We've never seen that before in history in terms of the movement in a single day on the back of inflation data. But it's also a great reminder, though, of you shouldn't try and pick these things. You shouldn't try and outguess the market. Being invested, if that is what your long-term investment goal is, if your horizon is long-term focus, there's no value in trying to pick the market. There's no value in trying to pick the individual stocks here. So, fair enough. I used to think like that. As at Kernel, we're all about long-term wealth. And one of the questions that we get asked quite often is, what are your tips for investing for kids? Let's say a 10 or 11-year horizon. So what would your tips be for that?
Kids is almost a great example of where we have seen people probably take better habits than what they would do almost for themselves. Often people investing for the kids do the things better than what they're investing on their own behalf. And kids have often got a very long investment horizon, often those that are contributing, be it grandparents, yourselves, family members at Christmas, for example. You are trying to build a nest egg for somebody in the future. And that investment horizon is often very long. It could be 5, 10, 20 years before they're going to access that. It could be through KiwiSaver, it could be through general investing. The key there is focusing on, if we think about diversified funds that most people be sort of familiar with, cash, conservative, balanced growth, high growth, longer investment horizons where you're trying to sort of maximize that long-term wealth. You want to be looking at that end that's more invested in growth assets. So 100% growth in terms of 100% invested in shares, like a high growth fund. Those are sort of the things that are probably more the end of the spectrum you want to look at for kids, because they have time on their side to ride the ups and downs. So you want to be invested in shares, which has been, over the long term, the best performing asset class. Some little more technical tricks though. In New Zealand, there's some really interesting tax issues to think about for kids. Often people talk about ETFs. Now, ETFs, exchange traded funds, simply mean that the units on that fund can be bought and sold on a stock exchange. If you are regularly investing for a kid, often what you would like to avoid though is those transaction fees. So listed funds, you'll have to buy through a brokerage. There will be a brokerage or transaction fee. Whereas an unlisted fund like Kernel, there are no transaction fees. So $1 that gets invested will be fully invested. You don't have a clip of the ticket before that. The other real interesting nuance in New Zealand is that listed funds, so ETFs in New Zealand, are actually taxed at a flat 28%. So not taxed at your PIR, your personal kind of investor rate. Why does that matter? Well, a child will actually be effectively, they have no tax, they have no income. So you don't want to have your investments taxed at a 28% with an ETF, when really you want to have a fund that would be taxing at that sort of 10.5 or 0% rate where possible, if you're on a lower PIR. So unlisted funds like Kernel are designed to be more tax efficient. And that means for a kid over time, or a child's account, more of that money will be invested, more of the money will remain in their account rather than being taxed at 28%. So yeah, that's some of the interesting little sound bites. I've got a few blogs on that. I encourage you to reach out if you've got any questions on how do kids' accounts work, how does kids' accounts work with KiwiSaver versus general investing.
Yeah, that point that you made about we do much better behaviors with our children's money than we do with ours, because I do the same.
Yeah.
So let's get into talking about our 3 new funds.
The big thing of the night, hedging and new funds. Yeah.
Hedging and new funds. So do you mind just giving us a little, brief overview of what our new funds are and what they mean? And then we can get into the characteristics of them.
Yeah, so Kernel, we have a range of investment options for you now. Obviously, we've got sort of general investing available where you can pick from any of our funds. We've got the savings accounts as well, so an online savings account, as well as KiwiSaver. Now, within the investing and KiwiSaver options, we have a range, I think it's 17 funds now. And critical in there, we've got the core building blocks. So for most investors, as of last week, we now have not only just our equity funds, but we also have some new funds, one being a cash fund. So the cash fund is a diversified fund that holds a range of cash type products, so term deposits, online accounts, short-term bonds, designed to reflect sort of the short-term market, the cash market. What that should do is give investors surety. Like the idea of a cash type fund is it's not like a conservative fund, because I think a lot of people have learned so far this year that conservative funds still invest in shares and can invest in bonds, and they can go down in value, whereas a cash fund should hold stable. And that's sort of been looking at the current yields on that index as sort of high 3% with a nice sort of PIR tax structure. So you get the benefit of the pie for a tax regime. Equally, we've launched a balanced fund. So we've had a lot of people sign up for KiwiSaver, and they really like the fact that we've got a high growth diversified fund. So unlike a lot of the banks where a growth fund may have 20-25% in bonds and cash, we've got a 100% diversified global share fund. And the idea there is if you've already used, particularly in KiwiSaver, if you've used your KiwiSaver to buy your house and you've got a long investment horizon, you may want to be looking at something that should, over time, help maximize those returns. But we knew that we had a lot of customers who are on their first home journey or closer to retirement, and we're looking at some other options. So we launched a balanced fund, and the balanced fund is 60% into growth assets. So those are shares spread across the globe in New Zealand, as well as bonds and cash, just help smooth the ups and downs. So Over the longer term, you shouldn't expect as high returns as the high growth, but equally you shouldn't see as much ups and down. And then at the very bottom of that spectrum is the cash fund. So that's perfect for short-term goals. If you are in retirement or you're very close to buying a house and you want surety that that money is going to be there, this is a really well-diversified fund holding short-term income assets that will give confidence that those should be there at the time. So those are the funds we launched. Equally, it's been busy. We don't slow down. We've had a really popular in the single sort of sector funds that we offer. We obviously give people a choice to be able to customize KiwiSaver or customize their investments to their different investment goals with a range of really tax and fee efficient products. And we've had some global equity funds, but what we've seen recently is some people go, actually, I would like to have a hedged version. And we'll come to that in a bit. But we launched a hedged version of our Global 100 fund. And we'll dive into in a second sort of what does hedging mean and why would you think about this. I do see quickly there from Cody, great to have a question come in, so feel free, any others that are listening, to drop a line. Why is an index tax different to an ETF? Nothing to do with us. That is actually the IRD. So in New Zealand, a lot of funds, so your KiwiSaver, your general funds that you'll see that has a product disclosure statement, which probably the big disclaimer here that I should have done at the start was any investment decision, make sure you read the product disclosure statement. If you want to know more information about Kernel's funds, obviously they are all on our website. And anything I've said so far in the first 20 minutes and that I'll say tonight is not advice. Why is there a difference? There are two types of PI tax in New Zealand. There is a multi-rate PI, which is what most KiwiSavers are, which is what Kernel funds are, where it actually taxes on your PIR rate. If you want to know what those terms are, what do they mean, have a look at our website. We've got it in our blogs and FAQs. Whereas listed PIs is another category in New Zealand. And listed PIs are taxed a bit more like a corporate, where on all distributions from the fund, they are taxed at a flat 28%, not at your PIR. So a little bit of inefficiency there. It's just the nature of the New Zealand market. That's not the same in other markets, but it is why Kernel set up the way we are, to try and be most efficient for all of our investors. Did we want to talk about hedging?
Yeah, let's get into it. It's a very complicated subject, and
we had a lot of questions on it.
We've had a lot of questions on it because a lot of people don't actually know what a hedged version of the Global 100 actually means and how it works. So let's start off with what is a hedge fund and how does it apply to our funds?
Should we clarify quickly that what it isn't is also equally as good? We had some people go, what is a hedge fund? People may hear that term used in a number of different use cases. You will see hedged funds, and hedged funds are actively managed funds where they are being speculative, they are taking, where they're buying positions, and they may also be selling positions at the same time and speculating on different assets to try and outperform the market. That's a nutshell. Whereas currency hedge funds, a fund that is hedged against the currency, is effectively trying to remove the impact of currency movements on your investment returns. So if you think about it, most investors will be diversified. They will hold investments in some form of global assets, either through the likes of Kernel or with your KiwiSaver. Your KiwiSaver will be globally diversified and it will own shares in Apple in the US as well as in New Zealand. When you buy that share in Apple or you hold that share in Apple, not only are your returns going to be impacted by the price movements and the up and down of Apple, but they're also going to be impacted by what happens between the United States dollar and the New Zealand dollar, because that is equally moving in real time. So unhedged funds, as an investor, you are going to get the impact of both the performance of the underlying assets as well as the currency. With a currency hedged fund, or what we will call, say, our Global 100 hedged fund, the hedging effectively is trying to remove the impact of the currency over time. So all that you should get is the return from the actual underlying investments. Why does that matter? Some really interesting things that can be beneficial. It can be a headwind. If we think about what's happened and why this is such a big talking point right now, the New Zealand dollar converted to US dollar at the start of the year was a bit over 70 cents. So that was, what the conversion rate would be. So, if you think about when you go on holiday, you have to exchange your New Zealand dollars into Australian dollars, for example. Now, what has happened over the year is that with all the turmoil globally, people have flooded back in terms of the US as the safe haven. So that's meant the US dollar has strengthened. And as that has strengthened, the New Zealand side of that has fallen, which means that if you own shares in the US, and you can see this with our Global 100, and it's probably good to go and have a look at the different returns. If you own shares in the US, say through our Global 100 fund, yes, the underlying shares haven't done well, but the currency to New Zealand dollars has fallen. So the assets that you've already bought with currency at 70 cents at the start of the year, that fell down to 55 cents. So the benefit of that falling currency into New Zealand has meant that you've actually got a bit of a tailwind boost. And for example, that change in the United States to New Zealand dollar conversion fell 20% this year at one point. So while the markets were down 20%, the fall in the currency by 20% actually offset those losses. But now what we've had is, okay, the NZD to USD has been at lows that it's not been at for a very long time. We were sitting about 55 cents, and people go, well, over time that could drift back up. And when currency goes the other way, rather than being a boost to your returns, it will actually create headwinds. So what we've seen is a lot more interest in market from people going, I would like to have a bit more currency hedged funds. And that is on the idea that take the S&P 500. The S&P 500 is down, but I don't really want to be buying right now the S&P 500 where the currency is so low, because yes, if the shares go back up, the currency may also go back up and it will offset my gains. And so we've had people looking for some hedged versions of that fund. Calling and trying to predict currencies and which way to go is an impossible game. Look, it is really impossible. What we're trying to do is give people flexibility and the tools that they need to. So we have an unhedged Global 100 fund and a hedged Global 100. They will perform differently at different times. Over the very long term, that should all wash out, but it gives people tools to change.
So stopping on that, so how does the Global 100 fund itself and the Global 100 hedged, how do they differ?
So the only difference is the hedging. One is unhedged, one is hedged. They hold the same underlying shares, it's the same effective fund. The difference is the unhedged will also be impacted by the movements in currency. The hedge will only be impacted by the performance of the underlying shares in that fund. Now, it's a good reminder why past performance is not something you should make an investment decision on. Because if you look at the Global 100 unhedged over the past 1 year on our website, the returns will actually look relatively well compared to markets. Does that mean that unhedged is the best going forward? Who knows, but you will still expect to see different rewards. So don't try and make a decision based on performance that you see for any investment decision. It's never a good idea. The other thing to think about with hedging is you may not realize it, but probably this is already happening for you somewhere. Pretty much every KiwiSaver scheme that you'll be invested into, their diversified funds, will have some form of hedging. What you will most often see is that the income part of the portfolio. So if we think about that balanced fund, a balanced fund that holds a whole lot of, so 40% of it into, say, income type assets, so bonds and cash. People often, historic norm within the financial sector is that global bonds will be hedged because these are sort of meant to be lower volatility to smooth that out. People don't want to have their more conservative part of their portfolio also impacted by currency, because currency isn't, smooth. It can be very volatile. As we've seen so far this year, it's moved 20%, and so that can have a big impact. So often, most KiwiSaver schemes will actually have a large portion of them hedged. I think the average balanced fund actually only has around 18 to 20% of that whole portfolio unhedged. So whether you know it or not, hedging is something that you've probably got exposure to, but it's a good chance to understand a little bit more. It's quite a complicated thing. I think it's often easier to explain this with some charts and some examples. So we've got a blog coming up soon, and there was a great blog as well by Money King that gives some examples. There are a few good guides out there that we can direct you to, that if you want to just see some practical world examples of what that means to your returns, what that means to currency, because I think when you see a few charts and you see some examples, that's a much better way of understanding it.
So we've got some questions come in, I think, on the same topic. So am I correct in understanding the hedge fund only matters if you are buying and selling a position? It would not be relevant if the dividends are being reinvested.
The dividends, so if you think about, say, our Global 100 fund, for all of our funds, except for the thematics, we give investors the option of a quarterly distribution from that fund, or you can automatically have it reinvested no transaction fees, no brokerage, back into more units. Again, if it was hedged, that would be buying more units in the hedge fund. So that will be whatever the fund is, you'll get the same.
Is there an options premium to pay on the hedged fund? How much expressed as a percentage?
So the cost of the hedging within a fund does have a little impact on returns, but we're talking fractions and fractions of a percent. It is not that significant at all in terms of the difference between returns of hedged and unhedged.
Okay.
Nothing in life is free, so there is a cost that impacts returns with the hedging, but it is what we would call basis points. So if you think about our fees on a lot of our funds are 0.25%, so that's 25 basis points. We're talking in the single basis points often is the impact of that in terms of the total returns on the fund.
Okay, so the next question is quite a good one because it was asked previously by someone else as well. So what is the rough cost of hedging for each dollar put into the hedged Global 100? How much goes into the assets versus the service cost of hedging currency? So before you answer it, I guess another way to spin it would be like, how do we absorb the cost of currency hedging in our funds?
So the cost impacts the return. So if you think about what happens with hedging in a hedged fund is you're taking out a bunch of contracts, typically with the banks, and sometimes the currency will, when you're trying to neutralize the impact of the currency, that will create positive cash flows into the fund and positive cash flows out. The net result is, though, that the returns will match the hedged index. And so the cost, though, of the hedging contracts themselves with the banks is in the basis point. So there is a small cost, but I would say generally in the scheme of the total operating cost of the funds, the management fees, it's sort of more of a rounding error. Why will the difference in returns between hedged and unhedged funds wash out of time? Yeah, that's probably good to call me out on that. There's no guarantee. But by that, what I mean is over the very long term, you would expect currencies that are doing this all the time to eventually kind of have their sort of standard long-term mean. And it does depend on the time periods, right? Because if you look over the past decade, that is slightly different if you look over the past 30 years. But a lot has also happened with our economies generally over the past 30 years. But you would expect the short-term movements to start to wash out. So for example, the US dollar to New Zealand dollar, that fell 20% this year, but it's actually already rebounded a bit. So I think it's now down only about 11% so far this year. So you expect these sort of movements to go up and down. And so short periods of time, you'll see this, but eventually they'll sort of equal out a bit. So the currency hedging thing, I think, is something that's good to understand what it is as you continue to go on investing. I think some people that are probably more sophisticated may want to make decisions based on it, but over the long term, it's still about focusing on what you want to control on, what sort of investments you actually want to be in.
So dividends are reinvested in the same currency as if I am invested in the S&P 500.
Same units, yes. So whatever fund, if you are reinvesting units, it will buy more units in that fund, and that ultimately, when you're getting more units, you're getting more underlying shares, and then depending on the fund, either those units in the fund are going to be hedged or unhedged.
Cool. I guess since we're on the topic of the USD, USD New Zealand dollar topic. Someone did say, the current New Zealand dollar obviously looks really, really bad against the USD. If I were to switch from the unhedged version to the hedged, would I get the same number of units?
A great point. The units may not necessarily be the same, but kind of don't worry about the units. And the reason why the units may not be exactly the same is the unit price of two different funds may not be identical. But if you had $100 in the Global 100 fund and you sold it and you got $100, you would reinvest $100. So you may end up with slightly different units, but that's not really the driver. That doesn't change anything. You've had $100 invested, you've still got $100 invested. Because the unit ratio is different, doesn't actually change the long-term impact of anything.
Okay. And does the Global 100 hedge fund purchase the underlying assets directly?
Yes. So we buy them. We buy the underlying stuff.
And what are the tax implications between, I know you've spoken about it briefly, but if we're holding it directly, what are the tax implications between an ETF, which is holding it somewhere else?
So one of the big things for Kernel is that for those that follow us closely or understand what we do with where we're going with the platform and the funds, is we really care about the long-term returns of investors, and we'll do everything we can to find the little inefficiencies. And so tax, as much as it's really boring, is something that's actually quite meaningful. So for all of our funds, we will physically go and buy all the companies around the globe to match the index, and that's the only way to be really tax efficient. For the US 500 fund, we do actually buy the Vanguard fund. The reason being is that that still actually gives the same tax benefits. So we'll wrap that up. Obviously, our S&P 500 is the hedged version, which has been something that obviously people have been asking a lot of questions on. Given that the S&P 500 is US shares, and a lot of the conversation this year has been about the change in the US dollar and where that is at the moment.
Okay, just one more question that's come through. How do you create more units in the fund without diluting the current value of units?
So what we're not doing, that's a great question, Cody, is it's not like putting more money in and we're spreading that around across more units. What we're doing is, if we had $1 million in a fund, if there was $1 million in a fund and the unit price was $1 and there was 1 million units, those pot of units owned a share of a whole bunch of underlying companies. If we had another $1 million, we're not just putting that in and diluting it. What we're doing is creating new units, and those new units go and buy underlying shares. So every time money comes in, it creates new units that buy new underlying assets, same in reverse going out. So there is never any dilutionary effect on investors. We're just growing the pool, the fund gets bigger, which means more scale, which means costs can come down. But what it doesn't do is to have any dilutionary effect on it.
Okay. So this question's quite a big one, so I won't try and reword it into my own words. This one? Okay. In the holdings for the S&P 500, there is a negative percent of value. So currently at the moment, it is minus 3.48% for forward contract. And I'm presuming it'll be similar for the hedged global 100. When this information becomes available, what does this negative value mean in practical terms?
This is a very technical question. Whoever submitted this one is paying great attention, which is good. And also a good reminder that actually for all our funds, we do publish all the holding information on our website. So everything is really transparent. And actually, you can even see it within the dashboard. If you didn't know that, within the fund pages, you can actually see all the holdings. That negative, the issue we have is with some of the contracts, you have to value them. So you can hold cash in the fund, but the value of those contracts, depending on what way the currency has moved that month, may show as negative or positive. It doesn't mean that it costs 4 cents for every dollar that's invested. Coming back, I guess, full circle. The key thing here is, no, it doesn't mean that hedging, the cost of hedging isn't 4 cents. The cost of hedging is basis points, but we have to calculate and account for whether there is a gain or a loss on those contracts every month to neutralize out the currency. So that gets really technical. I'm happy to have a conversation offline around how hedging is accounted for. I guess the key message there, though, is I'm reading between the lines that it's saying, does it cost 4% to hedge? No, and that's not the cost, and it's not kind of what you will always see. So keep an eye on the hedging, and you will see the differences each month depending on what is happening with currencies.
Just last question. So the unit itself acts like a signal large investor, and intertrading within the unit occurs too, which keeps trading costs low.
Yeah, trading costs. So effectively what we have is a giant pot that holds all these underlying shares. And if you take the Global 100, we are investing in 100 different companies around the globe. We're buying shares in those, and that pot of money is then divided up into units. As more money comes in, more units are created, and the pot gets bigger. And what we're doing is benefiting from those efficiencies of buying those underlying costs, spreading those costs. And I guess the other really interesting thing with index funds that a lot of people probably don't also realize is a big benefit is that obviously every time you trade, even within a fund now, there is a cost. Things aren't free. There is a transaction cost or something. With an index fund versus, say, an actively managed fund, the underlying shares that the fund owns, the turnover of those, the amount of trading we have to do is very infrequent. It's sort of typically only quarterly. And so if there was no new money coming into a fund, we actually very, very rarely would have to trade the underlying shares. And that's another big benefit, because that means that there is less cost for the fund. Whereas an actively managed fund, on average, will probably trade about 10 times more often the underlying companies in those funds. And that's just 10 times more cost. One of the questions we had here, do the diversified funds like balance and high growth invest in hedge? Yes, so you can have a look. I encourage, if you are looking at those diversified funds, you want to really understand them. Obviously, at a high level, the high growth fund is 98% or more invested into shares. The balance is 60% into shares, 40% into sort of fixed income, bonds, etc. And the cash is cash type assets. So that gives people a lot of control and choice over how they're managing different investing goals. You can have a mix. You all have different goals. Maybe you have some money that you're putting aside for short term, others as a retirement. So your KiwiSaver may be very different to what you're doing with your wedding fund, for example. But I encourage you, if you want to understand actually though more of the detail about that mix, there's the Statement of Investment Policies and Objectives, the SIPO. So in the documents section of our website, at the bottom, right beside the PDS, you can see the SIPO, and in the SIPO, it will tell you exactly the mix in terms of how much is hedged, how much is unhedged. In short, the high growth fund at the moment, the international equities, is approximately 50-50 hedged and unhedged. So I encourage you to have a look. If you really want to get into those details, go have a look at those documents and it will give you everything you need to know.
Oh, okay, I'll touch on that one because I did promise I might answer it. So from the top of your head, can you give us, I guess, a brief breakdown of what the historical performance data is between your unhedged Global 100 and your hedged?
So the nice thing about index funds is that while the hedged fund is new, it's not like an actively managed fund. We can actually look back to history and see what has returns look like. So what I would encourage you to do, while the fund is new, the index that we track has got a long-term history that you can go and compare. So if you Google S&P Global 100 X controversial weapons, because the index that that fund tracks excludes controversial weapons, you can find a hedged version and an unhedged version of a website run by S&P. And we can actually probably chuck up a link to that. So maybe we can comment back with that, send you to it. In there, you can actually go and see 1, 3, 5, and sometimes even 10 years worth of historic information around the indices that we track. So if you ever want to know more info, I think a lot of our fund pages even link away to the S&P site, because each of the indices we track have their own web page run by the index providers, and you can get a lot of historic information. We try and give you as much information as possible. Those that really care and want a bit more history and context, that's a great place to go to, and our team can easily direct you to it anytime.
Great. Before we move on to our cash and balanced funds, we do have some last few questions from Cody. Yep. So what is the tax on the currency gains?
Tax in the same way that we tax international shares under the fifth regime. So it's taxed using the FDR method. So the hedging gains and losses are taxed under the same structure. What that should mean is that you have equal parity with it. A great piece of international tax.
Yeah. Lots to dig into. As a business, what's your view on working through advisors versus direct with clients?
We work across the spectrum. So we actually have a Kernel's, it's been really exciting. At just 3 years old, what we're doing with the platform, all the different tools that we're giving investors, we have a real diverse mix. So we've got thousands and thousands of investors that are using our platform, and they'll come from all walks of life. Equally, we've got independent financial advisors, we've got iwi, we've got charitable trusts that use some of our funds. We don't pay commissions, we don't pay any fees. I think seeing an independent financial advisor can be really useful for some people, particularly maybe you've got some inheritance or you've got some retirement planning. I think where a lot of the value comes though from is not necessarily on designing an investment portfolio. I think that's what a lot of people think some financial advisors do. What I think a lot of people get value from is seeing somebody that can give them a financial plan. And by that, I mean, you can go and see somebody and they're often fixed costs and they will sit down with you and go, okay, what do you want to achieve? So you want to retire at 55, you want to have a batch. This is what you're earning at the moment. This is how you're going to set up the kids. And that financial plan will run a bunch of scenarios for you to go, well, actually, maybe you need to work 1 year longer if you want to have some comfort to make sure that you don't run out of money in retirement. So I think financial planning is actually a really valuable thing for a lot of people. At some point in their life, they may want to use, and often they're fixed fees. So you can go and see somebody and they'll be, it may be, a couple of $1,000s, but it's a professional service and they'll do a lot of work mapping out all the different scenarios for you. So I think that's a great thing to think about for people that want to get a big picture of their life. And some of them are very holistic. They'll look at, well, should you pay down your mortgage? This is what you should do for your children now. you need to work a bit longer, save this, and that will get you to where your goals are.
Yeah, I'll add to that. I mean, you pay to go see the doctor.
Yeah.
You know, I feel like people should pay for financial advice because that's a really, really important element in life. So
for a lot of people, there are a lot of things that you can do yourself. And I think we see, with what we're trying to design with the Kernel platform, is really intuitive. It encourages you on the right things that actually make long-term, growing financial security really easy and intuitive. And everything's designed to support that. But equally, there are some complexities. Some of us will always have some more complex situations than others. And that's where independence can be really important.
All right, last one from Cody. Do you think the tax advantages on New Zealand shares outweighs the growth potential on global shares?
Cody, you're coming with all the great questions.
I love it. It's good.
And fantastic that you're thinking about tax, because that is my personal area of passion as much as Prerna is 5 weeks in trying to get up to speed on me talking about fifth tax. So it is quite high. The hurdle threshold for international investments, depending on your sort of tax rate, can sort of be as high as 1.5%, 1.8%. That's how much more international shares will need to return to kind of get the same net result in New Zealand. And one of those is the tax regimes. Part of that is the fact that in New Zealand investment, you can benefit from imputation credits. I guess the key thing here is it's not one or the other. And so you've raised a good point that there is a difference, but it isn't one or the other. And actually, if you've ever seen one of those little heat maps where they map out the best performing country, like share markets from each country over a year, if you look at that over the big picture, it is random noise. Now, some years it's Switzerland, some years it's Jamaica and New Zealand, etc. It is random noise. So you want to be diversified across markets, across sectors, which is why the tax efficiency is low. I guess what that comes down to is why we have what's called a home bias. So a lot of investors in most markets have what's called home bias, and that is where New Zealand is actually a fraction of 1% of the global financial markets. So why do you have more than a fraction of 1% invested in New Zealand shares? The efficiencies of New Zealand, the fact that it is your local market, is one of those reasons why often you'll see investors have 5, 10, 20% of their wealth invested in New Zealand shares, not just all invested overseas. Cool.
Right. All right. Well, let's move on to the cash and balance funds before we run out of time.
Yeah.
So can you please provide a breakdown on what our balance fund and cash fund is invested in?
So in a matter of a couple of weeks, you will actually be able to see all of this on our website, because as mentioned, everything is really transparent. We show you all of the holdings, all the information that you need. But what you'll see in the balance fund is a mix of globally and local shares, so broad diversification of shares. You'll also see some cash investments. So within the income part, that 40%, there is going to be cash, short-term bonds, and global bonds as well. So you do get a full mix of global bonds, New Zealand, as well as cash. So it is a fully diversified fund. The idea of these funds is that, particularly in KiwiSaver, yes, we give you all the choice to custom mix it how you like, but for a lot of people, a really cost-efficient, tax-efficient, well-diversified structure is the best thing to go about. And so that's what's in the balance fund, but you'll be able to see each and every one of those investments very soon.
Yep.
Do both funds pay distributions? Just closing out the first one. Does it include government, corporate? Yes, there is government. There will be government. There is also corporate investments in that as well. Do funds pay distributions? Yep, keeping it really consistent. So other than the thematic funds like the electric vehicle, all the funds will have quarterly distributions, and you have the choice either to take that as income or invest it. Obviously, within KiwiSaver, it just automatically will continue to be reinvested.
Just letting you know, Kenny, that we'll be back to your question in a minute. We'll just cover off these ones and we'll be back. So here's an example. We're looking to buy a home in the next couple of years or so, and we want to use our KiwiSaver for the deposit. So what would your take be on moving the KiwiSaver balance to the Kernel balance fund with that in mind?
This is a great bigger question, I think, on switching. And interestingly, KiwiSaver transfers, so that's moving from one provider to another, is down 40% this year. And part of that is when COVID hit, we had a spike of people moving out of growth funds into cash funds. And that's bad. And particularly if your investment horizon hadn't changed. And particularly what happened there was real quick, people sold out of their growth funds, bought into and switched to a cash fund, and then the markets had a big recovery. And so you missed out on those returns. And it was still only about 6% of people that actually did that, but it was enough to have a lot of campaign, a lot of the regulator, the industry reminded people, don't switch. And kind of one of the issues was it was almost too good. And now we've got a lot of people who have realized, oh, my KiwiSaver balance is down a bit. I can't transfer, I can't switch because I will lock in those losses. And that's not true in the sense that you could still be in the wrong type of fund for your investment horizon. You may be paying too much in fees, or you may not be aligned in a fund that's meeting your values, or with a provider that's meeting your values. It is perfectly fine, or it's no issue if you're selling out of a balanced fund and going into a balanced fund, or say you're going from cash into growth, because what you're going from is, say, cash going into a growth fund is you're selling out of cash, which is going to do this over time, and buying into a lot of shares, which if they are down, that may do a greater recovery over time. The issue is when you have had investments that have fallen quickly and then you're selling those to go into something that over the long term isn't the same mix. So going from a balance to a balance or balance to a high growth, you're going to a similar mix. So you can move providers and it doesn't really make a big difference. So if you find somebody that you want to be with because it's better fees, better tax, better values, or suits you, that's perfectly fine. What you don't want to do, though, is sell out of growth to go to cash because you're concerned about the markets if you're still not planning to use your money for a long period of time. Coming back to that specific question, planning to buy a home next couple of years and use KiwiSaver for the deposit. If you're already imbalanced, obviously what we talk about with these sort of investments, and this isn't personal advice, but typically what you talk about is the sooner you need the money, the more sort of conservative that you need to be in. So if you're a long period of time, high growth type investments, if you need it in sort of 5-7 years, balanced. Or if you've got real immediate needs, cash, and maybe cash over a conservative, because we've seen conservative funds down like 10% so far this year. There is some nuance to all of this though, because if KiwiSaver is a relatively small part of your deposit still, the movement may not be that big a difference anyway. You're regularly contributing to it as well. So it's a really hard one to call. I don't think it's always just a vanilla, but obviously as you get closer to needing that money, you want to have confidence it's going to be there. And I think people have been in conservative funds that have planning to very short term buy their home with it, probably have been the ones that have been caught most off guard, because if as a couple, you had $60,000 in your KiwiSaver and that was going to go towards your first home, and then in the last 12 months you've lost 10%. Well, $6,000 is actually quite a big difference in terms of your deposit. And
so when you say short term, are we talking 1 to 2 years?
Yeah, that real short term. Yeah.
Cool. Just reverting back to the cash. Does the cash plus fund invest in deposits only from Heartland Bank or other banks as well?
No. So a couple of interesting things. So obviously we've got within the Kernel platform now, if you go in there, if you don't have an account, I encourage you to have a play around. You can have your investments, you have your KiwiSaver. We have this save account, which is a 34-day notice saver account. The current interest rate is 3.5%. That is taxed at your RWT rate. That may be a great spot for, say, emergency savings, short-term cash needs. The cash fund is a pie. It is tradable like all of our funds twice a week. And the tax rate on that is obviously at your PIR, and that is a well-diversified mix of cash. So I don't even know if there's anything actually in there at the moment from Heartland. It is, big banks, it's short-term sort of debt stuff. So it is a broad mix of short-term cash type products. So quite different to the savings account. Can be used for similar sort of purposes, or maybe want to be used, obviously, our savings account isn't available in KiwiSaver. So obviously you would have to look at things like the cash fund if that was for your KiwiSaver.
Cool. Just on that, what would the logic be for having both cash in both the savings and the cash funds?
You may want to set up a savings goal using the savings account, but your KiwiSaver or investments to be in the cash fund. So it probably depends on things like your tax rates. For some investors, they may want to be in something that's a pie fund for the tax purposes, how liquid you want it to be. Yeah.
Sorry, Kenny, I think we missed this one when we were talking about the Global 100 before. So if you're invested in the Global 100 and the S&P 500, are you then doubling up?
There is a Global 100. So if you look at any big, broad global equity index, so be it a 10,000 stock index or the Global 100, they all have a similar sort of mix of countries, and the US typically makes up about 70% of those index. So somewhere between 65 to 70% of any global equity index is invested in the US. And that's just a reflection of the fact that the US market is the dominant market in financial services, in the financial sector and our economy. So you will have an overlap in countries. Why do you maybe do that? Maybe one is because you want to manage currency. S&P 500 is hedged. The other is that you may be an investor who wants to purposely overweight the US. These are all personal decisions, but there is an overlap in terms of that country overlap. So it is something to be conscious of, and why, if you look at the diversified funds that we have, we don't have a mix of those funds.
If we were to just get your thoughts on it, would it be worth investing in both?
I think you want to be conscious of not to overlap too much. Have a look at the likes of our high growth fund, and you can kind of see the sector mix and the country mix from that. And it's a good example of about the key things you want to look at in terms of diversification. Ensure you've got good country mix, ensure you've got a good mix across different sectors. Because my early comment about sometimes the US does really well, sometimes other markets do really well. You'll get a lot of fluctuation in that. So that's why having a good global diversification is key.
All right, Cody, you said you can mix and match funds. Is there a way to do this so you know across your fund mix where you sit in terms of conservative and balance, etc.?
Great question. We have got a lot planned for our platform, not only in the next few weeks, but also 2023. So I really encourage everybody who's either using our platform or wants to use it to send in some requests. It does shape our thinking. We've got a lot happening at the moment that support how you track towards certain investment objectives. We've just launched a multi-fund buying function. We've got a great auto invest. Within the investment space, we've got to do a little bit more work on it, but we have the ability to actually go and see at your whole portfolio level all of the single companies that you're invested in. So say you invested in 5 funds through Kernel Invest, you can go into the Insights tab and actually see the dollar amount that you have in each of the underlying companies spread around the globe. You can even see what country mixes that you have. So if you pick and mix a few of these things, you can see the combination of stocks that you have, the combination of countries. There's a bit more we need to do with that in terms of being able to show you things like the split between growth assets and income assets and sectors. But that's definitely stuff that we consider to be able to do with that.
Okay. What's our expense ratio?
For pretty much all of our funds, it's 0.25%, except for the thematic, so electric vehicles, moonshots, and clean energy, which is 0.45%.
All right, this is a good one. Does Kernel give personalized financial advice?
We do not give personalized financial advice. Again, I think it's great to, if you want personalized financial advice, go and see somebody that's independent. It's always nice to be able to speak to somebody that is impartial, and they should be impartial. Find somebody that is fee for service, that's not getting commissions or incentivized. We know a lot of independent advisors. So if you want to speak to an independent advisor, there are a couple of great lists. Money Hub actually has a great list of independent advisors. Equally, feel free to reach out to our team. We can give you some names of people in your area, and we will never give you one name. We would just say, well, here are a bunch of different people. Go and speak to them. Find who works for you. There is no relationship between anybody we deal with on the advice front in that sense. And we won't provide advice. We can, though. We've got a great customer success team. We've got an 0800 number on our website, so you can call us and we can answer any questions that you have about funds, the platform, your experience, what's coming up for Kernel. So do reach out. We just can't tell you, obviously, what the best investment for you is.
Yeah. This is more of a general comment, but you might want to comment on it anyway. It'll be really useful or good to be able to have the funds graded and weighted to spit out the overall risk profile.
Yeah, I 100% agree that there's a bunch of things that are very exciting we want to do there. We've got a lot planned, as mentioned, in the next few weeks, as well as a very big 2023 coming as we expand what Kernel can do for investors across the country.
Yeah. Did we miss out on anything? Do we?
Just quickly, I guess, a couple of rapid fire questions that we've got here. If the index yield at maturity of the cash fund is 3.54 and the notice saver currently offers a guaranteed 2.5, actually it's 3.5, what would be the logic in having cash fund? Even if the interest rate was the same, if the cash fund was 3.5 and the notice saver was 3.5, the cash fund has a management fee of 0.25, but the big difference is that the cash fund is taxed at your PIR. So if you were on a 33 or a 39% tax rate, you may still actually be better off through the cash fund, despite the management fee, because of the tax savings rather than paying tax at your RWT rate. So something to think about. Some general rapid fire questions, and encourage anybody got any final questions to spit them in before we disappear.
Oh, here we go. Hold on.
Is there an option to move our funds without having to sell and buy again? Switching is something that's definitely on our roadmap, including a bunch more that we've got planned, probably for the start of Q2 next year, around how can people manage their investments and the timing frequency of that. Why did we choose a management fee rather than a buying selling fee?
I love that question.
With lower management fees? Well, what we'd like to be able to offer investors is, no transaction fees is really great, because it means that you can be fully invested, that we're not incentivized by you trading. I think that's a big philosophical thing for us, is that the core of most people's investments should be well diversified, low cost. I don't want our business to be incentivized by you having to trade your portfolio, because trading your portfolio is not a good thing. You shouldn't be chopping and changing all the time. So what we want to offer is exceptionally low management fees, where you have the full flexibility to trade at the frequency that you suit, to invest regularly as you suit, where our incentives are all aligned around long-term well-being. There is always cost as well, and there are costs that we have to pay in terms of running great index funds that are variable, and that means we do have to have a variable fee. We have to pass through those costs, so that is also part of the rationale there. Great. So we've got a couple of questions coming in here. Final questions.
That's a good question, Cody. You know what? I was thinking the same thing when I joined Kernel. Why do you think index funds are so underrepresented in the marketplace?
I feel Cody should reach out and needs a Kernel t-shirt or an umbrella, because these are fantastic questions. Drop us a line, Cody. Why do you think index funds are so? So for those that don't know, I've been involved in index funds in New Zealand since 2014. So I've spent a long part of my time trying to grow index funds here. When I started, we had $300 million was invested in index funds in terms of what people were investing generally. If you look at New Zealand, we're still talking about 4%, whereas the US market's about 40% held in index funds. We're catching up. Fun fact, we were actually the...
I just called that, sorry.
We were I think the fifth country in the world to launch exchange traded funds. Now, obviously, as mentioned, there are a few tax inefficiencies, but at the time we actually launched them because there were some tax benefits. We were 5 years ahead of Australia when it came to those index type funds. What we had, though, is just a lack of innovation here, the size of the market, and just general financial awareness, financial literacy in New Zealand. We're seeing that changing a lot now, and probably the biggest driver, if you look at where we are versus Australia was sort of a decade ahead of us with their superannuation equivalent to our KiwiSaver. KiwiSaver is now getting big enough that most people are starting to get more engaged with investing and getting engaged with their KiwiSaver, figuring out what they want to do with the money. We're less obsessed with property. So I think there are a lot of things that are happening right now that are starting to make people aware of index funds. And if we look at the growth of Kernel, and effectively we are now managing, we have hundreds of millions of dollars that we've got on behalf of Kiwis, and that's tens of thousands of Kiwis across the country now that we're effectively supporting in one way or the other. I think the tide is changing, and when it comes to KiwiSaver as well, we're seeing a lot of people realize actually a lot of the big banks, a lot of the traditional providers aren't innovating. They're not delivering me what I need. They're not focusing on the customer or myself, and so we're seeing a lot of change there. So I think, Cody, watch the space over the next few years. We'll see a bit of a change, I think, in terms of that awareness. Yeah.
What is the recommended time horizon for the balanced fund?
I think typically the balanced fund, so looking at that sort of 5 to 7 years is kind of really where you should be thinking about, because there are still equities in there. There are still other things. Now, you can mix and match. You could have the balanced fund and some cash fund and mix them up as well.
All right. From a risk perspective, if Kernel as a company goes bankrupt, is our money safe?
Perfect. Great question as well. We actually got a blog on that, which has a lovely little diagram that you can go and have a look at. The way that the financial regulations are in New Zealand, that the fact that we're a fully licensed fund managed by the FMA, that was a very big process to go through. Any retail fund, so by that I mean a fund in New Zealand that has a product disclosure statement. So not a wholesale fund, but a product disclosure statement retail fund, like a KiwiSaver scheme. Effectively, all pretty much operate the same way. So the way that we are structured is effectively exactly the same as a bank, that each fund is its own little pot. There is no claim on any of the assets. We have none of the money ever comes via Kernel, by the way. We're effectively only giving instructions. So you have independent supervisors, or what's a trustee, who are also licensed by the regulator and act as the eyes and ears for the customers. You have an independent custodian, you have the assets held separately. Effectively, everything is fully segregated out with independent custodians, the whole work. So the way we're set up is identical to the way a bank would be set up. And if any manager in New Zealand that was set up in that way, be it the biggest bank or any newest provider, what would effectively happen is if something happened to that business, the supervisor steps in and they would just move those money to either another manager or close that to give your money back. So the nice thing about the New Zealand market, particularly since 2016, when these regulations really changed, we've got a really robust market now, a really high quality regulatory regime. And the nice thing is that it's a real level playing field in terms of how everybody's set up.
All right. How likely is a cash fund to provide a negative return, and when it's likely to happen, or if at all?
If you hold a very short term, say like debt instrument, on paper you could value that where it goes negative for a very short period of time. But if you held it and it paid out, it's the same, a bit like a bond. When we've looked at that index, never over its history back to sometime in the 1990s.
Since 1999.
1999 since that index, it's never had a period where it's been negative for an entire month.
Yeah. It's never had a quarterly decline either. So it's
That's
been good
index.
so far.
Yeah.
Okay. Do you foresee any changes
to franking credits?
Sorry, my eyesight's really bad.
By franking credits, is that meaning the Australian franking credits being able to claim them in the same way that you have invitation credits in New Zealand? If that's the case, I would say no. Don't see that changing at all. That's an Aussie thing. Hamish.
Hamish. With some
Hi, to you both.
With some exciting stuff coming up with Kernel, with some cash sitting in Kernel account, would you suggest investing now or waiting for the cool stuff we have coming up? We have cool stuff.
The cool stuff is a lot what we want to do is now with the platform. So a lot of the tools and features and things that we want to just make that platform experience that much better. There is so much we want to do. We've got a really great team here in Auckland, which I would say we're still a relatively small team in terms of what we do. So we really appreciate the fact that so many thousands of Kiwis are now coming on this journey, and all of that feedback goes into shaping the roadmap, how we prioritize the features. Bigger question though, Hamish, probably a key thing, and it's the little plug for dollar cost averaging. If it's a market concern, the technical piece is that statistically, if you had a lump sum of money, you are better to put it into the market.
Yeah.
That's just statistic. That doesn't account for that human emotion though. We always have buyer's remorse. If you put your money into the market and whatever the investment was and it went down 1% tomorrow, we're always going to have a little remorse. So while statistically it's better to invest if you had a lump sum, sometimes people want to split that out. So we had a great example of some people go, actually, I am going, and this was an example that somebody reached out the other day, and we think, how do we build this? They're going to put some money into the cash fund, but they're going to sell down a little bit every single month to invest. And that's just their personal view. They want to slowly drip feed into the market. Equally though, they want to be able to be getting a return on that money in the meantime. So those are great ways that you can think about how you manage and how do you want to get into the market.
I do want you to answer this question though. Are there any plans on launching a bond fund at some point?
I think one of the great values of Kernel is we want to give people the full flexibility to be able to align, because everybody's got unique investment goals and we've got a lot that we want to do. We don't also, I'm really conscious that we don't just become a big supermarket of investment choices. Because reality is most people don't need that. That just creates complexity and cost. What we want to do is make it as efficient as possible for people to build their wealth around their own unique goals. So you'll see a lot more of that. But there are a few more things in the works that we'll sort of talk more on in the new year. So encourage you to keep an eye on what's happening.
Are you considering funds that invest into ventures?
No. And do you have funds that are more weighted to dividends? Yes, we do. We have a really interesting fund called Global Dividend Aristocrats. That's a fascinating. Companies to be classified as a global dividend aristocrat have had to maintain or increase their dividends for 10 consecutive years or more. If they cut a dividend or suspend it or pause, they are out of the index. So these are companies who have been around for a long period of time, who have been really consistent dividend payers and growers. The key here is high dividend paying isn't always best, because high dividends can happen in the short term where companies' valuation has fallen and they may not be sustainable in being able to pay that level of dividend. What the dividend risk is looking for is the sustainability of above average sort of growing dividends over time. So dividend aristocrats is really interesting. They're really common in sort of US. You can even buy US only dividend aristocrat funds, so US equity dividend aristocrat. To be a US dividend aristocrat, it's actually 25 years. And I think the average period that those companies in that index have maintained or increased their dividend is roughly about 37 years. So these are companies that have had decades of paying out or increasing dividends.
That's good. That's good.
I think that has been a fantastic whirlwind. Really appreciate everybody's questions, and big shout out to Cody on
great
all
questions.
the fire through.
Oh, hold on, we've got one last one. What do you think of cryptocurrencies, and do you have any plans for any index that contains these? The performance of these has not been great.
I don't know how we answer that question at the time to wrap up. That is not a 30-second question. 30-second question. It is a whole other space, and interesting looking at the worst performing index this year. I think it is the cryptocurrency index.
It is. It was,
Let's dive into that on another chat at some point, Joe Random. Happy to dive into it. It is, look, it's another sphere, I think, and I think we talk a lot about core satellite investing. We think that we're the home for where people should build their core of their wealth. They're giving them the tools that are the most efficient ways to build long-term wealth. But you can have satellite investments and other investments in other places that are best for that. So as we've seen recently with the FTX saga, sometimes you really want to make sure that you've got, if you are got those sort of assets, that's in something that is going to stand the test of time. So look, really appreciate everybody's time, particularly for sticking around a little bit longer than sort of planned. As always, love getting the questions. Really encourage you to dive into the platform, have a look, send us in your feedback, reach out to the team at any time. Thanks, Prerna, for running through all those questions. Hopefully,
I was really nervous, but I didn't.
Yeah, it was great. Like obviously a few weeks in, and we've dived straight into some really complicated stuff. Hedging wise, we will put out some examples soon, and hopefully they'll answer a few more questions, because it is one of those topics that sometimes some visuals can really help. And we will happily send you through some of the guides. So thanks again, everybody. Thanks for joining us. If you've got any questions, reach out at any time. We'll chat soon.
See you later.